The views expressed in this podcast are not to be taken as either trading nor financial advice. Neither the announcer nor the Sirius Report make any claims to be certified financial advisors, and all reporting is dedicated solely towards being both informative and educational. Greetings and welcome everyone to the Sirius Report Market Wrap-Up for Tuesday, September 24th, 2024. Today we're going to take a look at some interesting markets because not of things that were going on necessarily in the US or even Europe like yesterday with the PMIs, but what the ramifications are for the Western markets, with China appearing to do some boosting for its equity markets as well as its financial system. So with this in mind, let's go ahead and jump right in and see how the markets fared, along with news on that front. The Dow was up 83 points to close out the trading day at 42,208. The S&P 500 was also in the green, up 14.36 points to 5732, and the Nasdaq regained the 18,000 handle, setting a new all-time record, up 100 points to 18,074. So, what's going on with the stock markets? Well, of course, the entire economy in the U.S. is now dependent upon the stock markets, but what are the stock markets dependent upon? They're primarily dependent upon the Fed, and especially front-running the Fed. Now that the real economy and neo-feudal confection featuring a parasitic predatory nobility vacuuming up virtually all the gains of the everything bubble, while the bottom 80% stumble along in debt serfdom, resigned to serving the top 10% who own 90% of the assets, is teetering on the precipice, clinging to the wealth effect of soaring assets courtesy of the Federal Reserve, etc. This is a line that came from an op-ed by Charles Hugh Smith, and I just wanted to read that paragraph because it is implicit what the U.S. economy, what the Fed, what everything really now is focused on here in the United States, and subsequently up to a certain point in Europe. It's all about financialization. It's about financialization through the equity markets, almost like screw the bond markets and the dollar. This is what the Fed is done by choosing to do cut rates. And of course, we know that Wall Street front ran this for more than a year in preparation for this. And this is why we went from all-time highs to a few days, the FOMC, and then all-time highs again. How long it's going to last is an interesting thing, because the bond markets are a much, 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 much bigger market than equities are, despite the fact that it's, several $1 trillion. But the question is, where is the wealth going to go? Is it going to go into dollars? Is it going to go into treasuries? Or is it going to go into things like gold and silver or real estate? That's what we're going to see in the near future. But with this in mind, let's go ahead and see how those bond markets fared today. Well, as opposed to yesterday, which had a recovery of yield spiking, everything was in decline, and there weren't any auctions to bring down the yields. The 10-year actually was down just 0.006 to 3.732%, while the 2-year actually fell quite a bit, 0.036 or 3 basis points to close out at 3.54. Now we have a 20 basis point difference between the 3-year and the 10-year. Well, what I was talking about with China. Okay, China fires a monetary bazooka, but according to Rabobank chief strategist, it won't be enough. Yesterday, the Chinese central bank had already announced a 10 basis point cut to its 14-day repo rate. More importantly, the PBOC announced a rare press conference for today's session, sparking market speculation that further measures were forthcoming. Now, rather than get into the whole gist of it, I'm going to touch upon some of the things that the PBOC mentioned in regards to this. First, the PBOC lowered the amount of reserves banks have to hold by 0.5 percentage points, And then added, depending upon conditions, the reserve requirement may be reduced another 25 to 50 basis points. So as opposed to lowering interest rates of borrowing from the Fed discount window, in this case, the PBOC is lowering the amount of reserves that banks have to have with their central bank, so they have more to lend. Whether this liquidity will be drawn depends on demand. To encourage borrowing, the PBOC cut the 7-day reverse repurchase rate from 1.7 to 1.5%, which is one of those that allows for interbank trading, or interbank lending, I apologize. And it was stated that the medium-term lending facility rate is expected to be cut by 0.3%. Crucially, these lower rates will not only apply to new borrowers, but also to outstanding loans. So you're going to see a number of loans that get rolled over, which is going to create a business and help things go along the way. Almost like being able to refinance your mortgage at a lower rate. That will do a lot of stimulus to a given market. Now, what had happened here with the dollar? Well, despite the fact that the PBOC made some cuts and made it easier to get credit in their banking system, the Chinese yuan, their currency, is rushing and accelerating even quicker towards 7-1 against the dollar. The dollar is declining no matter what. And this is one of the important things that we have to recognize of what the Fed did and what Powell did, is he chose to save the equity markets and the housing bubble at the expense of the dollar and the bond markets. And with de-dollarization going at an accelerating rate, you should start seeing an accelerating rate of the dollar's collapse, the purchasing power. Because here's an interesting caveat. Because the Fed did not allow the prices to decline, disinflation, to go back about 20% of what most people lost in their purchasing power because of inflation in prices in gasoline, in prices in rents, prices in housing, prices in food. Instead of allowing the disinflation to occur to go back to where we were at the time of leaving the pandemic, now, just because they're lowering rates, it's going to increase inflation, and the prices that went up 20+% over the last two to 2.5 years are going to stay up there. And if inflation kicks because of lowering rates, it's going to be even more. And wages are not increasing because unemployment is starting to collapse. The dollar ended up the day down 49 cents on the DXY to close out at 100.36. Against a basket of currencies in the Western world. And then we have the big boys today. Gold closed at a new all-time high, up $28.90, closing out the trading session at $26.57. But silver was the big one for the day, up nearly 5%, closing out up $1.43 to $32.15 with a high of $32.32 about an hour ago before it started having some sell-offs in the after-hours markets. What does this mean for gold and silver? Well, we talked about silver yesterday in India and their massive purchase because they've lowered the duties to import it in, and now we have something out from Goldman Sachs. Goldman commodity traders. Gold buying on our desk has been relentless, and silver is starting to move too. We're starting to get institutions, not just central banks, not just sovereign governments, but we're starting to get investment institutions to buy gold and silver. Something remarkable happened in the price of gold back in early 2022, around the time of the Ukraine conflict. Having previously tracked gold ETF inflows to the tick, the price of gold suddenly disconnected and exploded higher, even as paper gold, as some say it, slumped. A few months later, and 2 years after the gold ETF holdings continued to drop, even as the price of gold rose, it finally happened. Attempts at brute gold price manipulation via shifts in ETF holdings finally ended. And with gold at all-time highs, ETF flows finally turned positive. A move which noted sent gold surging even higher as go. So the bottom line is this. Gold, the physical gold price has disconnected in large part thanks to the Shanghai Gold Exchange, which only deals in physical commodities, not the paper price of gold or the spot price of gold, but the actual physical price of gold and silver has disconnected with the paper price, with the ETFs, and it's being forced on, no matter how much they try to manipulate the paper markets through margin or through abstract naked shorting. Those shorts are getting busted every time. There's always buyers coming in. There's always buyers ready. And it is impossible at this point, without destroying the COMEX completely, for the leaders of the COMEX to come out and say, well, we're going to allow selling, but we're not going to allow buying. They have to do both. Otherwise, the jig is up. Take a look at cryptocurrency. Well, the last 24 hours of trading, Bitcoin is regaining the 64,000 handle, up 1.29% to 64,155. And Ethereum, after having 3 straight days of 3+% gains, was just up 0.04% to 26.48. In the oil markets, well, after a little bit of a sell-off yesterday, we are back in the green for both WTI and for Brent. WTI was closed out the day up $1.17 to 71.56, and Brent crude was up $1.22 to 75.12, showing that the value of the dollar in relation to energy is starting to widen once again. Not good for the incumbent party going into an election. Some of the economic data for the day. U.S. consumer confidence plunges the most in 3 years as the labor market weakens significantly. So we have where pretty much not only is the American consumer losing their jobs, not making as much money, but now they're going to stop buying, because this is what happens when you are in the middle of a recession and you're not sure of where your next paycheck's going to be. Home prices hit record high, but year-over-year appreciation slows significantly. So just like the fact that the equity markets before the Fed announcement of a rate cut last week were at all-time highs, so too, despite the fact that we've had a little bit of slowdown, pullback in mortgage rates, those home prices remain at or near all-time highs. Now, this is not across the board. This is just the median average. But the 20-city composite index rose 0.27% month over month and left the year-over-year price change at plus 5.92%. That's the lowest since November, but guess what? It's still going up. So what's going to happen when they lower mortgage rate or interest rates due to more rate cuts? Mortgage rates go down, bond yields go down, and yet the prices are already near all-time highs. You're going to have a bubble like you can't imagine, and you're not going to have any buyers because they're going to be out of work. Go figure. Anyway, we're going to close out the day's show. DOJ reportedly preparing to hit Visa with antitrust suit over debit card monopoly. Well, the sad part of it about it is yes, there's monopolistic practices in pretty much all of these different financial institutions in one capacity or another. But when you see the DOJ or the SEC or whomever going after somebody, you have to question, is it either political or does that government entity just need money? Because more often than not, there's not going to be a criminal investigation into this. It's going to be, how much can we have leverage over you, offer you a fine, you settle, you'll make it up in about 3 days of going back to your business practices, and we'll have a little bit more money that we can have in our coffers. Anyway, I want to thank everybody as always for stopping by to get your market wrap up here at the Sirius Report for Tuesday, September 24th, 2024. Don't forget to subscribe, like, share, comment. Let anyone know if you think this is valuable to them. And until the next time we get together, everyone, have a great Tuesday.